All right, y'all. Well, this is Weston Means, Bay Area Realtor, once again here in the San Francisco Bay Area. Today I'm in the Oakland office with my guy Julian.
There we go. What's going
He's
on?
with Take Flight Solutions. Him and I met at a investor meetup in Danville, I think it was about a year ago.
Man, it's crazy. Time goes by so quickly, bro.
It's been a while, man. It's crazy.
Man. And I see you doing big stuff, man. I see you on social media, man.
I'm doing my best, man.
I heard you came up with this podcast, and I'm honored to be here.
Yeah, I told him a year ago, like, let's do some content together, and it's finally coming to fruition.
Hey.
A year later. It's been way too long.
I love it because a lot of people come to me and say like, "Hey, let's do something," and we never hear, we never connect.
Oh,
right?
man.
So man, I really respect.
That's not
this
me,
man.
bro.
He keeps his word, right? That's why I love it. It's hard to find people who actually keep their word, bro.
That's
so,
what I try to
you,
do. Oh, thank you. I appreciate that, man. Well, Jay is what I would call a credit specialist. Is that how you would characterize yourself? So he specializes in credit, how to improve credit, what credit can do for you, and things like that. So I prepared a bunch of questions. Some of these questions came from social media. But first and foremost, what is credit and why is it important?
Generally, credit is the ability to borrow and pay back money, right? And it's important because the best thing that we could leverage is either people's time or people's money, right? But how we're going to be able to borrow money if we don't have a way to be able to show that we're responsible to pay things back, right?
Right.
So when you hear about a credit report, I think it's like the adult report card, right?
I like that.
So in school, school judges you, right, based on what are your past achievements, right? Whether you got an A, B, C in math,
right?
Your track record, the credit report is the same thing, right?
Okay.
If you want to go to the bank to apply for a mortgage or apply for a business credit card, what they're going to do is pull your credit report, and as long as they see that you've been able to pay things back on time, you've been able to pay things down, right, and then have a good amount of different types of accounts, there's a good chance that they're going to trust you to lend money.
So you need a variety of accounts.
A variety, man.
So like how many would be the sweet spot, you think? Is there a sweet spot or does it?
It depends on what you're trying to apply for. So give me an example. Like let's just say come up with like a bleep applicant. What are they looking to apply for?
All right, well, let's say someone is, because I'm in real estate, I'm going to make it about real estate. Say someone is trying to apply for a loan.
Okay.
Like they're trying to get a mortgage, they're trying to buy a place. Let's say maybe it's a condo in like the Richmond Marina.
Okay, cool. One thing that I do, because I do a lot of home buyer seminars, work with a lot of loan officers, one thing that I've realized is that it's highly dependent upon your personal credit, right? And that's why I asked you what specifically are they applying for, because if we're applying for a business credit card, or if they're applying for an auto loan, it might be something different, right?
Okay.
But when they apply for a mortgage, a lot of loan officers are going to look at your credit score. And when I'm on the phone with a client and they say, I want to be able to buy a home, I said, okay, have you talked to a loan officer? Have you talked to a realtor? Have they given you an idea of the minimum credit score you need to get approved, right? And correct me if I'm wrong, because you're in the space. I've worked with some loan officers, and they say once you start getting to like a 680 and above, you start getting approved for down payment assistance, start getting approved for different types of grants. And look, is why would we use our own money? We can use somebody else's, right?
Exactly.
Right.
So, absolutely.
Especially in the Bay Area where everything is crazy
high,
right?
Yeah.
The average a single family might be bigger out here in Oakland, but like 800.
Oh man, and a lot of places over $1 million. A lot of places over like 1.2. And I grew up out here. I'm from Berkeley, and like a lot of folks that I grew up with can't even afford to live here. It's like insane.
It's crazy.
And it's sad.
It's hard to find people who are still in the Bay when we grow up. Because I grew up right around the corner in Vallejo. So like a lot of people who are here now are like transplants, right? It's hard to find people who actually live out here in the Bay because they just can't afford it and they move out.
Because of the tech industry, Silicon Valley, a lot of tech companies moving into San Francisco, even Oakland. So that has driven up the prices a lot, and it's priced out a lot of people that I grew up with, and it's made it really hard for a lot of people out there. So this is actually one of the reasons why I wanted to start this podcast is like just getting that financial information out there where people can just take it and they can kind of like run with it and maybe make some life changes, just little tweaks here and there, you know, like improve your credit and work up towards maybe buying a house out here, or maybe you want to buy a house back east somewhere like Arizona or Texas. Obviously, a lot of people have been doing that because the prices are just a lot lower out there.
That's why it's so important to be able to find a professional, right? Someone like you where they just market, you know, there's little hot spots where you might be able to get something that you could afford, right? Going back to your back, I just never answered it.
Yeah, I was going to redirect us back to that.
So, what should we have on our credit to be able to get approved for a mortgage?
A mortgage, yeah.
Right. So, one thing I always tell people to do is first pull your credit report. You can pull your credit report from annualcreditreport.com, right?
Is that free?
It's free.
Okay. Annualcreditreport.com.
You're able to pull all 3 credit reports: your TransUnion, Experian, and Equifax credit reports.
Okay.
And with that, you're gonna have a full detailed information about what's going on with your credit, so you'll know exactly what type of accounts you have, whether with credit cards, with auto loans, with student loans, everything of the sort.
Cool.
The big thing is where a lot of people struggle is that they just don't have, or they have a lot of negative accounts, right? As in derogatory accounts, charge-offs, collections.
Okay.
Repos, right?
And what is a derogatory account?
Yeah,
just for the folks out there.
Exactly. A derogatory account is basically a bad debt. Let's just say that Citibank gave you a credit card. Let's just say you ran up the credit card.
Yeah.
$10,000, right?
Okay.
And you had bad times, you couldn't pay it back, or you decided not to pay it back.
Okay.
Citibank is going to reach out to you to say, hey, West, I'm looking to get this money back. What's going on? And if you just keep ignoring them, after 120 days, what they're going to do is turn that account that's reported on your credit to what is called a charge-off, right?
Okay.
So basically, a charge-off means is that they're going to take the debt, write it off on their taxes, right? So the Citibank is going to say, okay, well, look, West owes us money, $10,000, we'll write off on our taxes, right?
Okay.
So we can at least get something out of it. We're counted as a loss, right? And then sometimes what they do is then sell that debt, that $10,000, to a collection company. So now the collection company,
Like a repo man?
yeah, something happened with the car, right? Now the collection company is going to try to come after you, whatever. So
Yeah.
making sure you have no derogatories, bad debt, removing any late payments, do as much as you can, right? Because at the end of the day, it's really about making sure you get at least a 680 credit score.
Yeah, and that really is the cutoff. I've talked to a lot of mortgage advisors out there, and to get the best programs and the best rates, you want to be at or above that 680.
Got you. No,
Yeah.
thanks for the confirmation on that.
Yeah.
Because people say 620, 630. I said, oh yeah, I heard that a 580 I can get approved. And I guess there's
There's a lot of misinformation out there.
I'm glad you confirmed that. But,
Yeah.
Making sure that have no negative accounts, adding healthy accounts on your credit report.
Okay.
I would always suggest people to have at least one credit. If you're going to get a mortgage, one credit card. If you have an auto loan, some student loans, of course, making sure that as low interest rate as possible.
Yeah.
And something that I love, and you might actually appreciate this, a lot of people don't know this. What would you say is your biggest, or for renters, what is their biggest expense right now?
Their rent?
What sense does it make that their biggest expense doesn't get reported to our credit report, but their credit cards do, their auto loan does, everything else gets reported, but their housing, something that they have to do every single month. What if there was a way that you could actually force report your rent to your credit report? Right?
Smart, because that's a cost that's coming in every month.
Exactly, right? So there's actually accounts out there like
Okay.
rentreporters.com. You can actually go to the website.
I haven't heard of that one.
Yeah, it's dope. I've done this for myself and I do this for all my clients.
Yeah.
You go to rentreporters.com, you can apply. You're gonna say, hey, Rent Reporters, I'm paying $1,800 a month. I want this to be reported in my credit report. Rent Reporters is gonna say, okay, no problem, prove it. They said what you have to do is upload a lease that you're paying $1,500 or $1,800 a month. Say who your landlord is, and what they'll do is they'll call your landlord and say, hey, has John Smith been paying $1,800 a month?
Yeah.
The landlord says yes. Now, every single month moving forward, they're going to report 100% payment history of a new account reporting rent to your credit report.
Wow.
And you can backdate 2 years.
That's crazy. And does the amount of the debt, because it's their biggest expense, does that affect their credit more because it's a bigger amount?
It doesn't matter too much. What really matters is that they're actually paying that account on a consecutive or consistent basis. As long as you're paying it, that's all they care about.
Gotcha. Okay. Wow. So that's a out-of-the-box solution for improving your credit without having to open a new credit account and risking, having a balance on there and not being able to pay it every month.
Think about it, right?
Yeah.
You start getting,
because you're gonna pay your rent anyway.
Exactly.
So wow.
You might as well get credit for it, right?
Yeah. Why not? Wow. That's amazing, man.
Well, let me ask you this, man.
Yeah.
I know you talk to a lot of renters probably on an everyday basis.
Pretty much, yeah.
So what do you find that, what credit problems do you find that people have the most common?
I'd say a lot of times it's reaching that 680. So I was actually going to ask you, if someone already has a derogatory account, as you stated it, what should they do in that case? Let's say they have like 1 or 2 derogatory accounts. What would they do?
Let's just say it's a collection account, right? Let's just say it's a collection that they have on it.
Like a credit card?
So let's just say it's like an AT&T bill that AT&T gave up on trying to collect, and they sold it to a company where they own the rights to be able to collect it.
To collect on that?
Right.
And at what point do they actually send out the repo people?
A lot of times it doesn't happen right away, but let's just say that you have a car, an auto loan, you default on it. What they're going to do is they're going to turn that to a repossession. They might take your car right away, but it may not reflect as a repossession until probably like 6 months. Depends if they can find your car, right? Because I know I have some clients where they're putting the cars in their garage or putting at their friend's house.
With some TV show I used to watch, I forget the name of it. Said these bulky dudes out there and they're like looking in people's backyards and trying to find their car. So you say after the 6-month period, that's when it starts to get more serious, or?
Yeah, that's where a lot of times, it all depends, right? But I've seen a lot of times where a auto loan would flip over into a repo, right? Because they might take your car now, but it may not turn into an actual repossession account, negative account, until within 6 months.
Gotcha. Okay.
But when it comes to deleting them off your credit report,
Yeah.
let's talk about that. There's 2 ways.
Okay.
Let's talk about the way that people should not. Okay. A lot of people think, okay, well, look,
That's a good start.
I got a repo, or I got this charged off card, or I got this collection. Let me just pay it off. That's probably the worst thing that you can do.
Oh.
Because a lot of people think just simply by paying it, the account will just disappear.
That's surprising because that's like what I would think logically, like that would be the best step.
Right,
Like
exactly.
if I have the money now, why don't I just pay it off and then I won't have the debt? It won't be. Does it turn back to a non-derogatory account once you pay it off?
So it doesn't, right? And that's the reason why a lot of people lose out on money. So let's just say there's a $5,000 collection. It's negatively hurting their credit report.
Okay.
A lot of people think, okay, I paid this $5,000. It's going to be positive. But what they're going to do is they'll take your money. They'll take the $5,000. But what they're going to do is update the balance on that account to 0. So you don't owe the debt. But the collection account will still be reported on your credit report. So it will still negative hurt you. So I've seen people lose out on thousands of dollars simply because they thought or they heard that by paying collections and derogatory accounts, that's going to boost their score.
See, this is crazy that stuff like this is not taught in school. People just, you rack up some credit card debt and then you're like, okay, now I have the money, I can pay it off. But like, no one knows this information. That's crazy.
And I want to say, if it is an open account, right? If it's open, yeah, definitely pay it. But if it's closed out like a derogatory, because once the term is derogatory, it's closed out.
Okay.
That means the deed is done. It's bad, right? But there's no reversing. But yeah, that's the one way to not.
So what's the way that you should do it?
So there's 2 ways, right? You can wait 7 years for it to naturally fall off your credit report. Who got time?
Does it get erased fully? Like after 7 years?
It will naturally fall off your credit report.
Oh, wow.
Yeah, after 7 years, 7 to 10 years.
That's dope.
Or you can go through the dispute process, right?
Okay.
There's a lot of different ways, and we don't want to spend 3 hours here, but one simple way to be able to delete negative items off your credit report is by using the FCRA. It's basically a set of laws. It's called the Fair Credit Reporting. It's a set of laws that govern how information on your credit report is reported. So one of the laws states that everything on your credit report must be 100% accurate, 100% complete, and 100% verifiable. And if there's anything on a credit report that's not that, we have a right to dispute and get it off your credit report, right?
Wow. So what type of things would those be?
And it's crazy, right? That's why it's so important to look at our credit report, because we don't realize there's a lot of inaccuracies that are actually reported.
Yeah. I didn't realize it really got this complex.
Yeah, exactly. Wow. So that's why I encourage people to pull all 3 credit reports, because if there is information that's reporting on TransUnion, but doesn't not match up with on Equifax or Experian, that's considered an inaccuracy, right? If you pull a 3 bureau credit report, there's a date on there called the date of last activity is the most important date on the credit report, even bigger than the date opened, date of last payment, because that is the date that determines how long a negative account will be reported on your credit report. So let's just say we got a collection, right?
Okay.
Negative derogatory account.
Yeah.
And it has a date of last activity, 2022. By law, after 7 years, it has to fall off your credit report. So
you got 5 more years to go.
Right, exactly. If it was 2024, yeah, it was 5 more years.
Yeah.
But what if TransUnion says one day of the date last activity. Experian says another day, and the Equifax says another day. And it happens all the time.
I've noticed that those three, they don't match up. When you pull all three of them, there can be vastly different a lot of times, like 10 points.
It's crazy, right? The scores are different, the dates are different. Those are all, it's considered inaccuracy because the dates are different. Because think about it, it's one account. But why do they have 3 different dates? So if you're able to find
do you know why that is?
Because they're sloppy. At the end of the day, the credit reporting agencies don't have the right information. They're not reporting it accurately. And it's on their responsibility to be able to make sure that they're reporting it the way it should be reported.
Man, I feel like everything these days should just be digitized. It should just all go into one database where they all just look at it.
And honestly, I think we should have one credit reporting agency. Come on, man.
I agree. Yeah, like why do we have 3? I don't understand why that would make sense.
It's crazy, man. But yeah, by identifying those inaccuracies, you can actually write to each of the credit reporting agencies saying like, hey, I recently looked at my credit report. I saw that this is inaccurate information. I need you guys to delete it off my credit. Yeah, they might come back and forth and come up with some BS. If you stay on them, they're persistence.
Yeah.
If they don't remove it or they don't update it, it has to be removed. So
Gotcha.
that's how a lot of times, that's just one way of like 20 ways you can delete.
They can tell you a lot more if you do a consultation with them.
Yeah. Instagram, I'll talk about that on my Instagram.
I know he has a lot of gems on his Instagram, so definitely check that out. J Talks Credit on IG. Now let's get into the next question. So I'm in real estate, obviously. I know your credit can affect how good of an interest rate you can get on your mortgage. What else does your credit affect?
Your ability to borrow money in general.
Yeah.
I know especially with the economy now, there's a lot of times people come into like a tight pinch where they need to borrow some money for an emergency, right? If they need to borrow money to get a home improvement, right? Or if they need to refinance, they want to get a credit card, right? Your overall credit is going to determine how much you're going to be able to borrow. It's going to determine what that interest rate is going to be. So as long as you're able to handle your credit report, maintain it, and as long as you're able to follow the data points, it's not going to be a lot of things you can't get approved for.
Got you. And in real estate, we talked about that 680 score being kind of like the benchmark. For other types of loans, like an auto loan, is it the same? Is it 680 or is it?
It's similar, right?
Okay.
It gets to a certain point with a mortgage where if you go underscore, you're probably not going to get approved, right? For auto loans, I've seen people with 600s get approved, right?
Okay.
Doesn't mean that is...
They get a worse interest rate though?
Exactly, right? That's where we started seeing interest rate 12, 15, 20%, right? Where it's like, man, you might as well bought a car with a credit card, right? So that's why I encourage people to fix your credit before you start going into buying auto loans, right? Or borrow money to buy a car. Because
you're going to be paying a lot in interest.
Then your car is going to be underwater. So if you're overpaying for a car that has low value. Fortunately, I run into a few people who come across this.
Got you. Something we were just talking about just made me think of something. One of my friends actually just asked me, so he has his own business and he was looking for small business loans. I know SBA has loans. Are there any loans that are like forgivable, grants? For small businesses and stuff like that?
Yeah, and I would say that's not my full specialty. However, I do know that it's difficult for profit business owners to get approved for grants that are just free money, right? Unless you're a nonprofit, because nonprofits, yes, there's plenty of money out there. There's an abundance of money for nonprofits.
Okay.
But when it comes to small business owners, yes, there are opportunities out there, but they're highly. It's best to be able to pose your business as helping the community, right? If you have a mission, right? And not seen as, hey, I'm starting this business
trying to make profit.
Can you give me some money so I can make more money?
Right. That doesn't, I mean, when you say that, it doesn't even sound like I wouldn't give money to someone like that. All right, well, let's move on because I know you have limited time here. I know you're a busy guy. Is it a good idea to track your credit score? And if so, or what tools do you recommend using for that? And how often should you check your score?
I suggest people to check their credit score at least once a month. You know, there's free apps out there. Everyone's heard of Credit Karma. People have heard of Credit Sesame. Those are cool, right? Yeah. And I'm not knocking them. However, what they use on their credit score model is called a Vantage Score 3.0.
Okay, so tell me about that.
The Vantage Score is not a bad credit score. A lot of people say, oh yeah, don't do Credit Karma because it's not accurate. It's not accurate. It's just they're using a different credit model. Okay. Right? They're using a Vantage Score model. But a lot of times when we go to the bank, right, and to apply for a loan, they're not using the Vantage score model to determine whether you're credit worthy. They're using what is called the FICO score model. And the FICO score model is the score that you want to actually look at, because that's going to be the most valuable, the most accurate. Yeah.
So why do they even have a Vantage one?
I guess I know
Just to confuse things even more. They just want us all to be confused and not be able to do anything. That's how I feel a lot of times.
Yeah, honestly, man, it's all a game, bro. It's like, how are we supposed to know all these rules, right? Because we're not taught it in school.
No, not at all.
It's just like we're just automatically supposed to know when we turn 18, right?
It makes no sense. Yeah. And then there's all these different agencies, and like they're giving you different scores, and it's just all convoluted. It's just.
Let me let me ask you, when was the first time you had learned about credit, or what was your first step in building your credit? Let's take it back.
I must have been, probably was like in my 20s maybe or something. Because I don't think I got any, well, I had a credit card probably in my late teens, but I didn't really track my credit score or anything like that. I just made sure to try to pay it off every month. Because like my parents told me, like, if you don't pay it off, it's gonna hurt your credit. So I always tried to pay it off, but I didn't really get into tracking it until I was probably like 21 or something.
Yeah.
And I think it was just because I had heard other people talk about tracking it, and then maybe I found out about some of these apps where you track your finances. I downloaded Mint a while back to track my finances.
Yeah, I remember Mint, yeah.
Now I use Rocket Money. I really like Rocket Money.
Really?
Yeah.
How different is it from Mint? Yeah.
It's basically the same, yeah. Like it tracks all of your finances, and it categorizes it in different categories. You'd have like your investment accounts, and then like savings and checking, and then it tracks your credit score too. But I don't know if it's Vantage or the other one you said.
Yeah, probably be. Is it a free app? So probably the free apps typically use the Vantage score, but I'm not saying it's not useful. Because like Credit Karma, you could use it to be able to get a general idea of what's on your credit, right? Which is cool, and it's a free way to. I'd rather people have a Vantage score and have an idea what's on the credit than not knowing. Right?
Yeah.
Yeah. When it goes back to what you're saying about the sites that we should use, one of my favorite is MyScore.
Okay.
MyScoreIQ.com. You can go there. They're going to pull all three of your FICO credits, and those are the scores that the banks are going to use, right? If you go to a lender, most institutions, they're going to look at your FICO.
Okay.
So if you go to MyScoreIQ.com, help you out with that.
Got you. And when you see your FICO credit scores from the 3 different agencies, if you just take the average of those 3, is that going to be like a pretty good ballpark of where your actual credit score is probably going to be?
Well, I guess it depends on where you're going to apply, right? Because I know some lenders, I have a loan officer friend, and she says we look at the middle school, right? So someone has a 700, a 730, a 700 on Experian, 730 on TransUnion, and a 780 on Equal. They're going to be looking at that, and they're going to go based on.
And that's not even in the middle of those 2.
Right, and it's not, right? And it's just whatever that middle score is, whatever rank from lowest, middle to highest, they're going to take that middle score.
Is that, so that's just like the legal thing, or is it arbitrary, or like?
Yeah, it all depends on the underwriter and what they decide to do. And
wow.
That's what makes everything so complicated, because there's no set rules. It's all highly dependent on how the underwriter wants to look at your credit.
Yeah, it almost sounds like they could just decide how they're feeling that day and just be like, oh, okay, your credit score is actually
crazy, right?
670 and not 680. Yeah, it sounds like you really need to be on top of this stuff, because otherwise there's a lot of different hands in this pot, and they don't really, all of them have your best interest in mind. So this is a question I got from Instagram. This is actually from a childhood friend of mine that I grew up with. He said, can being an authorized user on somebody else's credit help your credit score without using their credit card, of course?
Yeah, one of the big data points, we talked about data points earlier, that really helps out your overall credit is the age of your credit. Right, the overall average age, right? So I typically like to have my clients' overall average age of all the accounts on the credit report to be about 4 to 5 years.
Is that kind of like the sweet spot?
That's the spot, right? Because once you start getting to that age, that's how people are able to get to the high stuff, right?
Gotcha.
Because they have a good variety of accounts, old and age, right? Because lenders like to see that you have accounts and you're able to handle them over a long period, as opposed to having a whole bunch of new accounts that are brand new. because it doesn't really show how well you can
It
handle
doesn't
credit.
show the history.
Right?
Yeah.
So they want to see old age.
You're right.
Exact consistency. Right? And there's some people who just don't have any credit at all, right? So if you don't have much credit, you don't have a lot of accounts, one of the best ways to be able to, or fastest ways to be able to overall boost your overall age is getting an authorized user account. So people might be asking, what is an authorized user account? Let's just say I got a Bank of America card that's 22,000 limit. 10 years old. Let's just say that Wes, you probably have fantastic credit, but let's just say
I try. I'm probably not as good as you though. You're the expert. I already learned like 10 things today that I had no idea about.
So let's just say that you had not much on your credit report. You didn't have a lot of aid. What I could do is I could add you as an authorized user on this account to your credit report, right? So I could add you as an authorized user on this account.
And anybody can do that for any credit card?
Anybody could do that.
Cool.
So now the age and history of this card will then be reported on your credit report.
Wow. So I would get the 10 years history on my, and I've only been added to it just now. Why don't I just get added onto all my parents' like accounts?
And that's what people should be doing.
Can I do that?
You can definitely do that. That's what
5 different credit cards?
You
or?
could. That's how I got into the 800 credit scores.
Damn.
Because I got added onto my grandmother's
That's
credit
fire,
card.
dude.
I got onto my mom's credit card.
Yeah.
It boosted my score 20, 30 points within 30 days. And I didn't
That's
have
insane, and that's so easy too.
It's so easy and it's free to do.
Wow.
But the problem is where a lot of people go into is that a lot of people don't know about it and they think, oh, is it legal to do? No, that's what it was made to do.
Right.
Anybody could do a simple Google search. What is an authorized user? You're gonna find out that people have been doing it for decades, right? Since credit cards have come out. You can add, and people started off doing it to be able to help their kids boost their score, right? So they could start building credit early.
And that's what it is, like what you just mentioned. When people don't know, it leads to a lot of fear, which leads to inaction, which leads to not improving things because you're scared to take that step or make that action because you don't know what to do.
Get this man a mic, man. This man preaching today, man.
Well, that's the whole reason for this podcast, man.
It's real, man. And I'm sure you see it a lot of time in your field too, man, where people might feel like they're kind of ready, but how many times have people will come to you and then they scare themselves out?
Oh, all the time.
It's all fear because they don't have the information, right?
Of course, yeah.
But that's why they have to get with you, right? Where they
that's why my whole thing is education. I want to walk you through all of the steps. I want to show you like what the data is and give you all the information and the tools so that you can make a good decision for yourself.
Once you get the right information, you make the right decision, right?
Exactly.
But by not having the right information, people
it leads to inaction.
Inaction, and then
people get froze.
In the same position over and over and over again.
Yeah. If you don't change anything, you're just going to be in the same spot that you're already at.
They say the best time to buy property was yesterday.
They say 10 years ago a lot of times.
The
best time to buy real estate was 10 years ago. Second best time is right now.
Right now. Come on now. Right now. So get the right information. Get connected with the right people. At least you will know, you'll have all the information that you need to be able to make an educated decision.
Got you. Okay, well, let's keep it moving real quick. What are some ways that you can hurt your credit?
Not paying things on time. Another thing a lot of people don't know, closing out your credit cards. Not only not paying, but closing them out. A lot of people think, oh, I paid off this credit card. I don't want to deal with it anymore. I'm just going to close it out. But a lot of people don't know is that with that credit card that you had, it came with a lot of age. We talked about having an overall age of 4 to 5 years. If you cut off that credit card,
it gets deleted from your report and you no longer have that age.
And then a lot of times I've seen people's scores decrease because they're closeout cards. Keep them open. You don't got to use them.
Just get rid of the plastic thing and then just keep it open.
What I tell people to do is like, if you pay off a card and you don't want to use it, right? Throw it in the back of a drawer. Set it on for an automatic payment for like your Netflix bill, just so it doesn't close out on its own. Because sometimes cards do that. After about 4 to 6 months with no activity, they'll just close it out for you.
Oh, I didn't know that.
Right.
Okay.
So having some type of activity, even if it's like gas once a month or having like your Netflix bill on there, and just to keep it active so you can keep it open, I've seen a lot of benefit in that.
And set up the auto pay. That's something I try to do on all my cards because like 5 or 6 credit cards, I'm not gonna remember to go into the app and like pay my credit card every month. Another thing I know that hurts your credit in real estate is when you apply for a loan and you do that hard pull on your credit, you get a ding on your credit score. I think it's like, it could be like 10 or 15 points.
I've seen it typically about like 2 to 5 points, but yeah, if you rack them up, every inquiry that you get could be 2.
So like if you do a mortgage application and then your mortgage expires after like 6 to 9 months and then you do it again, it gets dinged every time you do another hard pull.
But I know if you, within a 30-day span, if you go apply for a mortgage, and you say you go to another lender, you go to another lender, it's gonna, on your credit score altogether, it's gonna only be seen as you can approve or can hit one time, right? So if you're gonna go shopping, best to do it in a 30-day window. But once you start getting past that, that's when, oh, you're gonna hit the 2 to 5 points.
That's what I tell all my clients when they go to apply for loans, mortgages. So first of all, you want to apply to like maybe 3 or 4 different lenders because you want to be able to compare the rates and the different programs they can offer. So you want all those hard pulls on your credit to happen within that 30-day period because then you'll just get that one hit on your credit and it's not going to be multiple hits.
Now that goes into working with a loan officer, right? People come to me and say, hey man, I'm looking to be able to buy a home. That's my goal for 2025. And I ask them like, okay, let's go down the process. Have you talked to a loan officer? Have you talked to a realtor? They haven't done that. I said, well, I asked, why not? They said, well, I don't know. My credit is messed up. I don't know. I want to fix it first.
It's that lack of information again, I feel like, which leads to the inaction. People don't know who to talk to or what steps to take.
So what is the best steps somebody should take? Let's just say they don't want to buy a home. And let's just say summer of 2025. Who do they need to talk to first? What's the first step?
I would say, honestly, the best thing to do would be to talk to a mortgage advisor, a loan advisor, and get pre-qualified. So that means that they're not going to do a hard pull on your credit. It's just going to be a soft pull. So they'll get an idea of where your credit score might be. And with that information, they can tell you what your interest rate would be and take a look at your finances and get an idea of what level of a home you'd actually be able to afford in your current financial state. That gives people a much better idea of like what type of homes I should be looking at, what are the areas, what's important to me, and then you can start thinking about what are non-negotiables. Do I need a good school district? Do I need a good neighborhood? You can get into that, but you have to get the financial aspect of it done first, because otherwise you're wasting your time looking at places that you might not even be able to afford.
How many times have people come to you and say, I want to go search out for houses?
It happens a lot more than you would think. I've had so many clients, like they'll go online and they'll look up the average mortgage rates and then they do their own calculations. But like there's so many different things that they don't know about that go into the calculations which affect your buying power. So like you could come up with estimates all day, but you're really not going to know until you talk to a loan advisor. So I always redirect them, get pre-qualified. It's not going to hurt your credit and it'll give you a much better idea of where you should be focusing your attention and your energy.
People shouldn't really be going to a loan officer first.
I'd say really that's number one. If you want to come talk to me first, I'll talk to you all day. That's fine. You can call me up. I'll give you advice. I'll set you up with loan advisors I've worked with in the past. Yeah, I'd say really that's the first step because you want to know what your actual price range is going to be, or at least around where it's going to be, so that you don't waste time looking at stuff and falling in love with homes that you're not really going to be able to afford.
So they should go to a loan officer, figure out where they are financially. This is not where it should be. So
They talk to you.
Talk to me. We turn them around. Get them at this point. After we get them turned around, should they go back to you to talk to, or should they go back to the loan officer to get approved?
Once you can get to that 680 score, which is what you can help them with, I'd say go with that pre-qualification. Let's see what your estimated price range is going to be. Do you want to try to get to that next level, maybe save up for another year or two, or do you want to pull the trigger on trying to find something? You can come talk to me. I'll tell you everything that's in that price range, which matches your other criteria. Like, hey, if you want to be in the East Bay, if you want to be in San Francisco, like you can tell me all that and I can show you what's available. And if any of those homes are interesting to you or you want to take a look, we can go do that. If you're not into any of the homes or you want to like save up and try to get something bigger and better in the future, we can also redirect you and come up with a game plan to make that happen as well. So it's really all about the financial planning, but it's also about understanding where you're at right now so you can know what the next step should be to get you to your actual goal.
How do they know when they're ready to be able to, let's just say cash-wise? Should I save over 20% to be able to buy?
That's a very common misconception, is that you have to save up 20% for a down payment. You don't necessarily have to have that. There are a lot of programs out there. There's like FHA, government programs. You can do as little as 3 or 3.5% down. A lot of times those programs come with a higher interest rate, so there are trade-offs definitely for that. But I mean, we're in a very high price point area. A 20% down payment on a $100,000 home is going to be $200K. That's a level of cash that a lot of people can't hit. I would say, no, you don't have to save up that much. You can get started whenever you feel like you're ready to start looking for a home. And I would compare what your rent is now and then what your estimated payment would be for something that you purchase, and then just compare those. Obviously, for the most part in the Bay Area, your payment's probably going to be higher than your rent. But if it's doable and if it's within your kind of like income, it's like less than half of your gross monthly income, and you're comfortable with that, I would say to pull the trigger sooner than later, because prices just keep going up over time. Obviously, they come down, they like dip, whatnot, but over time, real estate has always gone up. The sooner you get in the game, the more equity you're going to build up and the more generational wealth you're going to build up.
I've heard a lot of people saying that, oh, I'm not going to buy because I'm waiting for the crash. What would be your response to that?
There's just no way you can really identify when a crash is going to happen, because it just depends on so many different factors. The last major recession we had was in 2008, and that was because of this whole system of lending where they were giving out these loans that were called ARMs, adjustable rate mortgages. And these were really not solid products. And honestly, they shouldn't have been sold to a lot of people. But these loan officers went out and they gave out these loans, and they had introductory rates that were really attractive. Back then, rates I think were like at probably 7 or whatever, pretty close to what they're at now. And they were offering like maybe 3 or 4% rates, but that was just for an introductory period of maybe like a year or 2 or 5 or whatever. And then after that introductory period, it was tied to the index, and so it was subject to go up by a lot. And so a lot of people got in over their heads, they got underwater, and they had to end. There was that big sell-off in 2008, and that's what caused a lot of supply. And when there's a lot of supply and demand stays the same, the prices come down. So that's exactly what happened. That's what caused the crash. There's just so many different things that could happen. It's impossible to know when the next crash is going to be. So I would say, I mean, right now, in comparison to the last 5 years, we're in an environment where the interest rates are elevated, because like in 2020, they went down to like 2%. Yeah, it was an insane time in real estate. But a lot of folks with a lot of money in tech and whatever else started buying homes and bidding 20, 40% above asking price. And that has driven up the prices. Now that we're in an elevated interest rate environment, a lot of these folks sideline themselves because they're like, oh, the rates are too high, I'm gonna wait till they go down, which is another common misconception. Because when you wait for the rates to come down, most other people are employing that same strategy. So when the rates do come down, everyone else is gonna come back, and that's gonna drive the prices up again. What I actually advise my clients to do is, I actually think it's a better environment to buy in a high interest rate environment, because even though your payment is gonna be significantly higher up front, you're gonna get a better price. You're not gonna have to compete against 20, 30 other offers, and you're gonna be able to get that home. And when rates come down, you're gonna be able to refinance. And then you're gonna refinance into a much lower payment. If it's 2, 3% lower, that's gonna be several $100s a month, maybe even $1,000 or more.
So I was told that the best way to be able to get in the market right now is to be able to buy a multifamily property as opposed to a single family. What's your take on that?
I always promote multifamily investing for a couple reasons. The first and most obvious reason is that you're going to get rental income, and the rental income is going to offset your mortgage. And I would say that multifamily homes are actually pretty much along the same lines as single family homes in a lot of markets. So like
price-wise,
the price point is about the same. So like you could get like a 2-bed, 1-bath unit, or like a 2-bed, 2-bath unit and move into that unit. But then you have 1, 2, 3 other units that are paying you rent every month, and you can use that rent to pay your mortgage. Your actual obligation is going to be a lot lower. Whereas if you bought a single family home, you're buying it for the same price as a multifamily, but you are responsible for the entire payment. With the duplex or triplex, your payment's going to be like cut in half or maybe even more.
Why don't more people do that?
A lot of people don't want to have to deal with the tenants. They're just like, I don't want to be a landlord. I don't want to have to like fix up stuff when their toilet is not working or whatever. A lot of folks out there, they'll get a property manager, and the property managers may take like 10% off of the top, but then it's like, you don't have to deal with anything. There's no headache for you. So it goes back to what we were talking about earlier about lack of information, misinformation, which leads to inaction. I know this to be true. I've seen people invest in multifamilies. People can get into a unit and they're paying less for their monthly obligation that they have to pay from their pockets is less than what they would pay if they rent and they own a home, and they have these people paying them where they get to use that money and pay it towards their own equity every month. So for me, it's kind of like a no-brainer, but a lot of people just don't want to have to deal with that, or they just don't know where to start. And so that's something I probably want to talk about more on this podcast, like multifamily investing. I feel like that's a really good good way. Get into a place and not have to pay a lot while also building your equity.
That's ridiculous, right? That's like a cheat code. And what I've heard is actually easier to be able to get a multifamily property compared to buying a single family. Is from what I've heard, but let me know if you've heard something. When you apply for a multifamily property, just say for a fourplex, they're going to use the income that the family is generating as income to be able to get approved. But if it's a single family, you don't have that.
You have no income to count towards your approval. So like the rental income that you get from the multifamily or projected rental income when you're looking to buy that home, they can count 75% of that towards your approval. So it'll actually increase your approval odds and it'll increase your buying power if there's that rental income coming in. So that's another thing a lot of people don't know.
That's a great way for people who can't afford a single family property in the Bay Area. That's a way to be able to get in the game. They got more income to be able to account for, and then they get into a multifamily property. Let's just say somebody using FHA, right? Because FHA you can't get.
For multifamilies, I don't think you can go with that. I think it has to be at least 10% down for a multifamily.
But you can get, so would be FHA? Wouldn't be that? Okay.
Probably not, yeah.
So what about the VA loan?
I'll have to double check on that, but I think you might be able to use a VA to buy a multifamily.
Let's just say we use some down payment assistance, get a multifamily, we will get in the game. Not only we have more income to count, we don't have to pay to put 20%, like you said.
Yeah.
And then once we get in the door, then we're making some income.
It's a lot easier than people make it out to be, but once you have the information, you can kind of let that marinate. And if you want to explore multifamily investing, you can talk to me or Julian. I think it's a really great way to get in and probably get your monthly living payments lower than what they would be if you rented.
Don't talk to me, talk to him. He said talk to me, he's the professional.
So I got one last thing for you. Do you have any other tips you want to leave the listeners with? Because I know you got so many. I've been following his Instagram channel. He just posts so many different reels, a lot of gems in there, so definitely check that out.
One thing that a lot of people are struggling with right now is credit card debt. You know, everything in COVID, what happened, some people lost their jobs, people got divorced, income, and also inflation is crazy. A lot of things are increasing in price, but our income is the same rate. So a lot of times, sometimes people will have to live off their credit card. And credit cards are built, so it's damn near impossible to get caught up sometimes, right? At 20, 25% interest rate, sometimes at 30% interest rate, not built for you to pay off, right? But if you have all this debt on your credit cards and they're decreasing your scores, now you can't get approved for a mortgage. What do, right? So I actually do this for a lot of my clients who are looking to be able to get approved for funding, right? They're trying to get approved for business credit or more capital for their business ventures. There are actually banks out there that will approve you for a personal loan that will pay off all your credit cards. You can pay them off in seven days. Wow. I just had a client. She had $30,000 worth of credit card debt between her and her kids. She couldn't pay it off. She had 2 or 3 jobs. It was just getting too much. She actually went to SoFi. SoFi is a bank where you can go to SoFi.com. They have a debt consolidation loan. This is different from a debt consolidation program. It's a little bit different. This is a debt consolidation loan where if you apply, you upload your proof of income, you ask them, they're going to pull your credit. It's going to be a soft pull. Then they're going to approve you for a personal loan that will pay off all your credit cards. And the great thing about that, right, is because a personal loan does not affect your credit the same way a credit card debt does, right? So let's just say you have $30,000 of debt on a credit card that's maxed out, right? What happens? Your score is going to get messed up. It's going to decrease. But if you got a $30,000 auto loan, that doesn't necessarily mean that your score is going to be in the 600s, right? All we're doing is just getting what's called an installment loan. It's kind of like a personal loan, an auto loan, student loan, any type of loan where installment loan debt is different from a revolving debt, which is credit card debt. We use an installment debt to pay off a revolving debt. Your credit utilization on your credit card is going to decrease. Your score is going to increase.
And it makes you a lot more manageable for you.
And exactly, right? Because a lot of times these installment loans have a lower interest rate. So now not only are you decreasing your credit utilization and increasing your scores, but now you're also paying less to pay off this debt.
Wow.
I just had a client pay off.
That's definitely a cheat code right there, man.
HappyMoney.com, Credibly.com. Those are all different sites where you can get approved for debt consolidation loans with a soft pull.
So what do you do for your clients, or like what do you do for folks that might be interested in becoming a client of yours? Do you offer like a consultation up front, or how do you do that?
So if anybody's coming to me and they're looking to get approved for a mortgage, one thing I always do is credit analyzation. So we will meet together, identify what your goals are, identify the timeline on when you're looking to be able to purchase, and we analyze your credit report. We use myscoreiq.com to be able to pull all three of your credit reports, and we analyze it. We do step by step, analyze what negative accounts that client has, what type of positive accounts, and see if there anything else needs to be added on. See if do they need to add a rental payment account, right? Whether it's rentreporters.com, whether it's BoomPay, right, which is another app where somebody could use to be able to force report their rent.
Oh.
Do they need to get another?
We're gonna have to include the links at the bottom here.
The
A lot of
bottom,
things you drop.
These are
All the links.
You can go to these sites,
Yeah.
force report your rent. But yeah, just making sure you have enough accounts on your credit report so that when they do go to a loan officer that you're working with, they're gonna get approved right away. That's what we will do, come up with a full game plan for you, right? And all this is just for your charge. It's not something that we charge for, right? If it seems like it's something that we can be able to help out with, then we can talk about the programs, talk about the pricing, how long the process takes and everything.
That's amazing, man. Well, I feel blessed to have a dude like this on my team.
Man, you
Someone
making me blush, man. You making me
someone I
blush.
can call when I have credit questions, because I have a lot of clients who do actually ask me credit questions, and a lot of times I don't know how to answer. So hopefully this will be helpful for a lot of y'all out there. Julian, thank you for stopping by. My dude,
it, man. It's an honor,
I
brother.
appreciate your time
Hey,
as
man,
always.
And if you have not been to this office, man, this might be the top office I've ever been in, man.
Yeah.
They got drinks in there, man.
It has that wow factor for sure.
They got food, man. They got music going.
There's actually a party going on right
Man,
now.
can
It
we turn
feels
the
like
camera
music.
on? This is nice, man. It's an honor, man. We should definitely do this again.
For sure. We definitely will, bro.
Yes, sir.
Thank you.